Welcome to the Modern CPA Success Show, where we're 100% focused on helping accounting firms achieve success. If you're an accounting firm owner who wants to learn how to provide virtual CFO services, then this podcast is for you.
All right, welcome to today's podcast. So today we're right in the middle, while this is recording, we're in the middle of the COVID-19 virus. And so we thought it'd be the perfect time to talk about dealing with difficult issues with your clients or dealing with difficult times for your clients. And obviously, times don't get much more difficult than they are right now for any client, no matter the industry, no matter what they do. Pretty much everybody is trying to figure out how to take the next steps forward at this point. So again, this won't be the only time you deal with this with your clients. So this podcast will be hopefully anytime you want to go back and listen to it, it'll help you think about how to walk clients through those times when they're having difficult cash flow or their forecast doesn't look great. But I think this is a perfect time to talk through this. So I'll start with you. So Adam's here again. So Adam, let's start with just the basics. So if a client's going through a difficult time, where should you start? What kind of topics should you bring up with them?
Yeah, I mean, you want to make sure that you have good housekeeping. I mean, garbage in, garbage out is still kind of the classic conversation with clients. It's really hard to consult on, hey, it could be this or it could be that based on what I'm seeing. So really just, I think having a really strong, tight relationship with your client is super important. So making sure financials are dialed in, they're done timely, they're accurate, and you have a real good understanding of what is going into all the numbers. I mean, I think that's kind of a unique place for people providing VCFO services, similar to how Summit's been doing it for a long time. I mean, we really understand what the revenue drivers are. We understand the expenses, how everything's connected. We make sure everything's reconciled, the balance sheet's tight. And it really puts us in a strong position then to do some forecasting. Because I think that's the building block and what you have to have first before you can even jump into forecasting.
And oftentimes, I mean, like you said with the housekeeping, you should already have a forecast in place, right? If you're doing VCFO meetings and you're meeting with your client every week or every month, you really, part of that process should be the forecast. So you already should have a good starting point. So I think definitely the forecast is the route to go. But, we've talked about this a lot internally. And I think the big difference in clients is clients with cash and clients without cash. So the clients with cash are a little bit, again, it's still a lot of work. There's still a lot of thinking you need to do, but the clients without cash are the ones that are usually urgent right away. So let's start there, Adam. So talk about if you have a client that doesn't have cash and you're the VCFO for them, what kind of conversations are you going to have in addition to those forecasting conversations, which we'll get into in a little bit here?
Yeah, again, as long as I've got a good understanding. I mean, if there's no cash in the company, there's probably another systemic problem. There's probably a design problem. So we really kind of take two approaches, especially if there's something that escalates things. I mean, the reality is most businesses only have 2 to 4 weeks of payrolls on their bank anyway. I mean, whenever you have a client that has a healthy cash reserve and it's 10, 20% of their annual revenue, that still goes pretty quick whenever revenue comes to a screeching halt. I mean, whenever we plan for this stuff, typically we're like, oh, sales are going to dip 20 or 30%. What do we do? Or 50% maybe in worst case scenario. I've never really, other than just a few circumstances where somebody's going bankrupt or something, have I ever really had to do any contingency planning for just a 100% halt of revenue like we're dealing with now. So it's definitely crazy times, and the cash burn is much faster and accelerated even with people with healthy cash reserves. But that said, the way I usually diagnose a situation is before I get into the timing, it really does come to plan design first. So I know that's kind of a difficult conversation with some clients. They're like, cool, like I get it. Like I want to build all this stuff out, but I need to know when I'm running out of cash tomorrow. And so in order to diagnose the problem though, because again, if we're in a really strong economy and you're not making money, there's a problem. You know what I mean? Like something's
Right.
not dialed in. Like, maybe the owner's taking too much money out. Maybe it's, there could be a bunch of different reasons, but more than likely, whenever you hear people say, well, I don't want to pay taxes, so I know how to just lose money. No, you're losing money because it's not doing very well. Like, sorry, I'd never spend $1 to save a quarter. Most of that stuff's just, it's nonsense. So anyway, plan design, break down the revenue, break down the drivers of the revenue, understand the direct and indirect costs, go through all the overhead items, make sure you have a good understanding about when they come out and about how much they are, bump that up against reality, because what'll end up happening is you'll make this nice little sketch of what the client's telling you and how everything works. And then you're going to want to take that and bump it up against what happened last year and the year before to kind of look for trends and go, hey, I hear what you're saying. We do this, this, and this, but that's not what our financials are saying. So again, that comes back to the housekeeping. Are we recording things wrong? Is there, do we have accurate information to back that up against? Or do we just have this different kind of view of the world of what we think should be happening, but that's the reality is it's not. Some clients don't understand a lot of times the difference between a markup and a margin, and I've made a pretty big impact with clients just walking through that definition before and realizing that they need to, move the needle a little bit on that stuff. So I think that's step one is the plan design. I want to look in a vacuum at what a 1-year cycle looks like and make sure that we're profitable. And then, then I can backfill in debt, because sometimes you have to be better than good. A lot of times companies without cash, it's because they're paying down debt. So then I say, okay, cool. We built a plan for 15%. And I think that's pretty top notch, 15% bottom line. However, you need 19% to pay for taxes and to pay debt. So this plan, this design is not going to work. So we got to go back to the drawing board with overhead. We have to go back to the drawing board with team costs, all those kind of things, material costs, if that's applicable, and then look at our drivers again. Now, you don't want to get pie in the sky and throw everything on revenue because, of course, nobody's met a forecast they didn't love. You want to, make sure that you're bathing it in reality. We talk about that a lot. But I think once you've done that and you come up with a plan design, then you can mobilize that and look at it in terms of a forecast.
I think the important thing, just to kind of summarize what you said there, and I don't think you said it directly, is the last thing you want to do is add a bunch of debt to a client that's not going to last a long time, right? So if a client doesn't have a good model and doesn't have a good plan in place, and then you're going to go through and add them through $200,000, $300,000 of debt that they're never going to be able to pay back because their business isn't sustainable, that's a big mistake. And that's a mistake from us on an advisor standpoint. Sometimes we have to have those tough conversations with the client, like Adam said, and say, hey, in order for us to take on this debt, I want you to show me a plan that's going to bring in 19%, 20% profitability for you, because I don't want to straddle you with debt and then you not be able to pay it back. And then we're in a tougher situation 3 months from now or 4 months from now, or maybe even a year from now. So I think that's the big thing is you want to make sure the company has a plan for now that we have this extra expense on the books. How are we going to still be profitable when we haven't been profitable in the past? And so it always is a tough conversation because you're usually with a company that's tough. And then, day one, something goes wrong. Oh crap, I only have $20,000 in the bank. How am I going to survive? Those are the companies that you have to have those tough conversations with and be like, all right, so now we're going to give you a bunch of debt and you're going to try to do something you've never done before, which is be profitable. And so I think it is a very good conversation to have.
Well, it's a slippery slope. I mean, people then go into factoring the receivables or, like you say, getting those daily or weekly payback loans that have an enormous interest rate. I mean, you got to treat it almost like, and I know time is super valuable. So like you said, somebody comes to you and they're like, hey, I don't have any money. What do I do next week to make payroll? I can't help you with next week's payroll. I mean, the reality is like at that point, we're just blocking and tackling and trying to figure out what you're going to do. You're going to have to move some pieces around. What we need to figure out is why do you only have 1 week's payroll and how do we fix that going forward? Think about it for those of the listeners that haven't been through a reorganization through bankruptcy, I mean, whenever you go to put together a plan for that, the court wants to know, what does your forecast look like? Do you have the ability to move forward? If you cannot build me a profitable plan, then we don't have, you might as well just go to total liquidation. So that's kind of the mentality and the movement that we take. So right out of the gate, but you don't want to do it haphazard. And that's why I was saying, like, you really got to dive into all these things, build it out. And then once you have it, then you can use that tool to say, okay, this is what we need to be. This is where we should be from an industry standpoint. This is where you need to be because of the situation you're in. Now, let's plug that into the forecast and play out where you are today, bake in your actuals. And, this is where we fold the balance sheet into things and we can kind of see how upside down you are, play out all the payments and go from that standpoint. Because now what we're talking about is what your burn rate is and what your what your ramp time is, so that we can kind of see how much runway we have, basically.
And I think you mentioned something really important there as well, is I think you have to make sure, again, if you're a small firm and you're the only CFO, this is easy. But if you have 3 or 4 CFOs for you, you have to make sure that you have CFOs that are strong enough to say, I can't help you with next week's payroll. Like, what do you want me to do? Like, I've been trying to tell you for the last 6 months, you need to save more cash, and now you're not. And so now you're leaning on me to help you with next week's payroll. So I think you have to have CFOs that are strong enough to give that advice, because it really is like, there's so many people out there that just want to fix the world and be like, okay, let's see what I can do to help you with that. And there really, a lot of times, there's not much you can do other than trying to get, if they don't have a line of credit in place already, you're trying to just pick which people to pay and which people not to pay, which is just not a fun conversation to have.
Yeah. And I'm going to channel some Kenny Rogers. I know he was in the news. You got to know when to hold them and know when to fold them. I mean, there's some situations where you get into the call, and I've told clients, I'm like, hey, look, we built a good plan. You are so far upside down. Our only way out is to walk through reorg. And I feel comfortable going into reorg because I know we have a good, solid plan moving forward that we can prove is workable. The problem is you just can't get out. It would take you 10 years to get out, or you're going to end up throwing good money after bad money, and we're going to be in too tough of a spot. So sometimes the reality of that conversation is just that. So whenever you turn it into the forecast and you play everything out, it's just like, now you got to double your sales at great margins. Is that possible? Not really. You know what I mean? So what does that mean? And what is that looking like? And then the next step that we take internally is we take that runway, that monthly runway on the forecast. So going from plan to forecast to the actual week over week cash flow. So we use a tool where we bring in all of the bank balances and everything, everybody that we owe, everybody that owes us, all the automatic transactions, and we play out a 13-week cash burn. So the forecast, whenever you're dealing with charts of accounts, can get a little imperfect, if you will. And so, you're looking at the design, and then you're looking at your runway, and you're going, okay, I think this is manageable. Now you have to get to like ground level, and who are we not going to pay, and who has to pay us in order to make payroll? How do we balance the line of credit? Those kind of things. And that's whenever we get, that third level, whenever we're getting a little bit deeper, if we're at like 10,000 feet at the forecast or at the plan, and 5,000 feet at the budget, now we're at ground level and we're getting ready to dig in. So we go through that. We figure out as much of the stuff that we can move, as many of the chess pieces we can move on our own. And then we have to probably go in and try to look at restructuring debt without bankruptcy. So that means, as a VCFO, getting on the horn and making connection with the banker and saying, hey, look, here's the situation we're in. I feel confident about our plan to dig out. This is what kind of relief I need from you, whether it's an interest-only payment for a while, or if it's a deferment, possibly a reorganization. That's tough whenever, times are, not doing well. They're not going to be too apt to help with just refinancing a bunch of other debt. That's not really going to be their thing either. They don't want to take on more exposure. And yeah, so I think that's whenever you actually then go below the surface and start helping them work through restructuring debt with credit card companies or with banks.
I think building that weekly plan is really where we as CFOs come in. This is when our clients need us most. And so I think, what we've done at Summit here is we've made sure we've talked to every one of our clients as soon as possible. Just check in with them, see how they're doing, see where they're at. But I also think, when Adam's talking about the detailed levels, this is the best thing about having a CFO on staff is you're prepared more quickly. And so that what we've told our team and what we've talked about as a team is a lot of companies go into this and they're in a wait and see mode. Let's wait and see what happens next week. Let's wait and see how many clients leave us. Let's wait and see where things are going. And what a client with the CFO has is they can scenario play those out. They can say, okay, right now we know we're here. So these are the steps we need to take. We need to stop. We need to try to renegotiate our rent. We need to let go of this one person. That's where we're at today. But where are we at if 2 weeks from now, 3 of our clients have left us? What are the steps we need to take? We need to be able to make those steps quickly. And that's really where the CFO comes in, is doing that planning and doing that, laying things out and say, okay, here's best case scenario, here's worst case scenario, and here's the best scenario. What are we going to do if each of these happen? And so that way, if any of those situations happen, they know the steps they need to take and they feel confident with them because they've already seen them. So they know, okay, 3 weeks from now, okay, we didn't lose 10 clients like we thought we were going to. We only lost 6. So that puts us in this realistic scenario. These are the 3 people we need to let go, or these are the 4 expenses I need to stop paying for. And so they're ready to make those decisions really quick once those scenarios actually come out. And I think that's really where us as CFOs are building value with our clients. And our clients are like, wow, I'm glad I had a CFO during this time, because the person that doesn't have the CFO is just waiting to see what happens. And they don't have these scenarios played out.
Yeah, I think that's a great point. So you heard me kind of walk from 10,000 feet to getting dug in. The problem is that's a couple month process. And so if a client's coming to you and saying, hey, I need to make payroll next week, what do? I just engaged you. I don't know. You know what I mean? That's going to be a tough call. So that's why it's important to get in front of your clients as soon as you can, engage them in that kind of retainer-based model of the VCFO, where you can have that ongoing relationship and understand everything. So to your point, whenever we need to, we can just flip a switch. And there's lots of times where we'll do modeling during our forecasting call. So it's like, okay, I need a good, better, best kind of approach. It looks like we're going to have to do this. We call it scaling up or scaling down. So we help clients scale their business up so that they're, as they grow, they're growing profitably and not just, running after the vanity of revenue. And then we also help clients scale down. So there's been a ton of times whenever our clients like, hey, we lost this or we lost that, or my pipeline's really dried up. What's my runway look like? And we'll get on a call and I'm like, okay, let's play it out. And we kind of put in the, doomsday scenario, albeit not what we're in today, but some doomsday scenarios. And then the client's like, oh, I didn't realize I had, 2 months to make the decision. And then we draw a line in the sand and say, hey, we've got 3 weeks to, let's see how A, B, and C play out. And in 3 weeks, that's whenever we need to make another decision. And if these things haven't panned out, then we have a contingency, plan A, plan B, and plan C, that kind of a thing. And you can do it super fast on an hour call with a client.
There's a lot of comfort to both me as a CFO and to our client if we're just doing what we've always done before, right? So to Adam's point, I've already done modeling with you in the last 12 months. I've already done it with you 8 times. Now we're just doing it again. Same tool, same spreadsheet, same tool, same software, whatever we're using to do this modeling. I'm pulling up the same thing. I'm doing the exact same thing we've always done. I'm just doing it with a little bit more drastic cuts in there. And there's a lot of comfort in that, being like, okay, well, this isn't as scary as I feel, because we're basically just handling it the same. We're just putting bigger cuts in there. So I think both from the CFO standpoint and from the client standpoint, if they've done this practice over and over again, it just adds a little bit of comfort. Okay, we just need to assume instead of our worst case scenario is a 20% cut, maybe our worst case scenario is a 50% cut. So the cuts are a little bigger there. So if they've done it several times already, it just adds that extra comfort to them when they're going through that conversation.
Yeah, I agree. I mean, it's definitely repetition definitely helps. I know I'm going to be working through some stuff with the client today, and it's all going to be about, just load balancing on the income statement. How do we keep the P&L in balance? So what they have done is they have a client list and they've knocked off certain clients that are no longer going to be paying. Some of them are just pausing. And so we're feeding that all through the forecast and then looking at what all of our financial ratios look like and then applying that into the balance sheet through our forecasting software that we use. And they can see in real time, when they run out of cash, what happens to their cash. And they can also see where they need to cut. Okay, so we lost client A, B, and C. They can see tangibly, we need to cut X amount of dollars in salaries, which equates to so many people. We need to cut X amount in administrative stuff, X amount in marketing, just to keep things proportionate on the way we scale down. And I think that peace of mind and that understanding of knowing when and where to cut is something that you can only provide if you're delivering this kind of a service on a regular basis.
I think it's also, having those conversations is not easy. You're talking about people, you're talking about, people that have jobs and have families and all that stuff. So the conversation is never easy, but I can tell you this much. I've been through this conversation both in my previous life at large corporations and now as a CFO several times with clients. The first thing that people are going to identify is there's 2 or 3 people they were thinking about cutting anyways because of performance and saying, if we have to get rid of 2 to 3 people, these are the 2 to 3 because, I've been trying to work with them. I've been trying to hold them on. I've been trying to get them up and trained. But now that we're in these tough times, I just don't think they have it anymore. So they're always going to have that first level of cuts of people that are they were going to move anyways. They're going to move on from anyways. It doesn't make it easy, but it makes it easier. And so I think that's the first thing you'll notice when you have these conversations with clients. And that's usually kind of the bad case scenario. Now, the worst case scenario, that's when you have to start talking about people that, are valued team members, and they'll start talking about furloughs, and they'll start saying, well, maybe we could just, have them take a cut in pay. And I think those are the type of conversations that you're going to have when you get to those deeper cuts. So Adam, you want to expand on, kind of furloughs, pay cuts, where you stand on those type of things?
Yeah, I mean, you definitely have to be careful with furloughs versus layoffs. Some of the furlough stuff, they're still an employee, for an amount of time. Doesn't mean they can't get unemployment and stuff, and it's all applicable to different state laws. So I don't want to get hung up in that. But we do a lot of times have clients that come to us and say, okay, well, what if we just take the entire team down 30% and we hang on to everybody? I've seen it work, for a short sprint here or there. But man, they has to be really super special circumstances, because what ends up, in our experience anyway, and Jamie, you might have a different one, but I think we share the same view, that what ends up happening is the people that are really good know who the people that aren't, and they don't feel as though they should be, in that same boat. And they're like you mentioned earlier, they know where the dead weight on the team is. And they're like, hey, why don't we trim that first? And if that's been trimmed, and then we all have to do it, different conversation. But if the first answer is just to trim across the board, you're going to end up losing the really good people and getting stuck with the people not so good, especially if the economy is relatively okay and you're just going through a thing. I mean, again, the circumstances today with COVID-19 are a little bit different than what they were 2 months ago. But believe me, these conversations happen in fantastic economies.
Yeah, and I think to that point, even now in the COVID-19, like let's say you go and you give 20% pay cuts across the board, and yeah, you may hold on to those superstars for the next 6 months, but once the economy does turn around, those people are going to remember that. They're going to be like, hey, they gave me a 20% pay cut in order to keep on to these people that aren't performing as well. Where's my loyalty? Why would I stay with this company when that's the way they handled this type of thing? And so it really is, again, from my experience as well, I agree with Adam. I think the pay cut path has not worked out majority of the times. One, it's not good for morale either. Like, and you're telling people that, okay, we're struggling, which they already know, but we're struggling. This is how we chose to handle it. And everybody's upset versus the 2 or 3 people that got laid off. And the last thing you want is a team of 30 people where everybody's upset because their pay just went down.
Yeah. And I mean, don't get me wrong. The intent is good. And everybody's like, hey, we're all in it together, and definitely love the kumbaya-ness of that proposal. It just practically usually doesn't run out very well, for all the reasons we just mentioned. So definitely got to be careful.
Cool. So I'm going to just take a second here to throw our email address out there. So again, we're always looking to improve our content and have this podcast really speak to the listeners. So if you have any topics you want us to talk about, you can email us at cpa@summitcpa.net. So again, any conversation ideas you have. Also, if you want to be a guest, we're going to have a couple guests coming on the show and a couple recent podcasts here. So we're excited to get those out there. But if you want to be a guest as well, feel free to email that account. Again, CPA@Summit, SUMMIT, CPA.net. So looking forward to hearing from our listeners. We've already got quite a few emails in there and try to tailor our topics for those, but we're always looking for more. So, Adam, we're kind of getting closer to the end here. Any other big tips that we need to be thinking about in this topic that we should be talking about with our clients? Any housekeeping stuff? You already mentioned that a little bit, but anything else that we should be thinking about as we have these conversations with our clients?
Yeah, I mean, right now, given the situation with COVID-19 and everything, what I would say is that we need to focus on documentation right now. So hard costs, soft costs, that kind of a thing. If you're setting people up, if your clients are setting people up to work from home and they're having to buy hardware, or they're having to do system updates or hire IT people in order to facilitate that stuff, recommendation is put it in a separate class or maybe a different chart of accounts so that you can kind of bucket all this stuff. We know that the IRS and the government loves the deal in tax credits. So whether they're real-time tax credits they're talking about right now that might offset, handling payroll, or potentially something on the back end, similar to how they calculate R&D credits. Maybe a year from now, after the dust settles, there'll be additional benefits that we can use to either offset loans or get money back somehow. You don't want to be combing through a client's stuff, a year from now, trying to figure out if it was or if it wasn't. Just go ahead and start documenting that stuff right now. I think that's a really important tip. And then, of course, just make sure that even though your clients are going to be wanting to cut fees and cut back, and they're going to need to, got to figure out a way to stay engaged because they're going to need us more than ever right now. So make sure you have 3 years worth of business returns ready. Make sure you got some financial statements ready. You're ready to present on like lost sales. Prep all your owners to get their PFS going. That personal financial statement is going to be important right now for anybody impacted and needing to get a loan through the SBA or whatever other means that comes out over the next couple of weeks.
Yeah, and anybody that's hired you to be a CFO wants you to be forward-looking. And so I think what Adam talked about there of like, okay, this is what we can expect. Like we've seen how quickly they've tried to act in terms of getting things out there in terms of support, but there's always going to be more. There's always going to be tax credits. And I think that having those conversations with the clients, be like, hey, just track your time that you're spending on this, track those costs, have them bucketed. So that way, if there are tax credits, we're not having to go back a year from now and trying to find this data because that's pretty much impossible. So I think giving those forward-looking tips is really providing the services that the clients expect from a VCFO, because I can't tell you how many reviews I've been in. They're like, yeah, you guys just aren't forward-looking enough. This is a way for us to be forward-looking. This is a way for us to be proactive about stuff that could happen and really giving our experience from past things and saying, hey, we've seen this in the past. This is the kind of stuff that you'll probably need a year from now. And if they don't need it, great, at least they have it. And, we still got the value of that conversation.
Yep. Agreed.
Cool. So any final thoughts, Adam, before we end this podcast?
Nope, that's it. And just, like I said, just get sticky with the client. Make sure you get in super deep and you'll be able to answer all these questions that pop up and help them clarify direction going forward. Most important thing we can provide.
Yep, this is where we see our value. The CFOs this is who people want to talk to whenever the problems go. There's a couple of advisors people go to, and we're definitely one of them. So make sure you're being there and talking to them as much as you can. But appreciate everybody listening, and thanks for joining the show.
Yep.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving modern CPA firm success. We're here to be a resource in this ever-changing industry.